Investing. Investing is primarily about using the capital markets to invest surplus cash for long-term growth of wealth. Introduction. Saving to build wealth is investing. When people have too much money to spend immediately, that is a surplus of disposable income. They become savers or investors. Investing happens over your lifetime. In your early adult years, you typically have little surplus to invest. Your first investments are in your home, although primarily financed with the debt of your mortgage. Then, perhaps in planning for children's education or for your retirement. After a period of just paying the bills, making the mortgage, and trying to put something away for retirement, you may have the chance to accumulate wealth. Your income increases in your career progresses. You have fewer dependents as children leave home. So your expenses decrease. You begin to think about your investment options. You have already been investing in your home and retirement, but those investments are being prescribed by their specific goals. You may reach this stage earlier or later in your life, but at some point you begin to think beyond your immediate situation and look to increase your real wealth and to your future financial health. Investing is about that future. 12.1 Investments and Markets. A brief overview. Learning objectives. First, identify the features and uses of issuing, owning, and trading bonds. 2. Identify the uses of issuing, owning, and trading stocks. 3. Identify the features and uses of issuing, owning, and trading commodities and derivatives. 4. Identify the features and uses of issuing, owning, and trading mutual funds, including exchange-traded funds and index funds. 5. Describe the reasons for different instruments in different markets. So before looking at the investment planning and strategy, it is important to take a closer look at the galaxy of investments and markets, where investing takes place. Understanding how markets work, how different investments work, and how different investors can use investments is critical to understanding how to begin to plan or investment goals and strategies. You have looked at using the money markets to save surplus cash for the short term. Investing is primarily about using the capital markets to invest surplus cash for the longer term. As in the money markets, when you invest in the capital markets, you are selling liquidity. The capital markets develop as a way for buyers to buy liquidity.
Now let us proceed to the bonds and bond markets. Bonds are debt. The bond issuer borrows by selling a bond, promising the buyer regular interest payment and then repayment of the principal at maturity. If a company wants to borrow, it could just go to one lender and borrow. But if the company wants to borrow a lot, it may be difficult to find any one investor with the capital and the inclination to make large a loan. Taking a large risk on only one borrower, in this case the company may need to find a lot of lenders who will each lend a little money, and this is done through selling bonds. A bond is a formal contract to repay borrowed money with interest, often referred to as the coupon, at fixed intervals. Corporations and governments, example federal, state, municipal, and foreign, borrow by assuming bonds. The interest rate on the bond may be a fixed interest rate or a floating interest rate that changes as underlying interest rates on the debt of comparable companies change. Underlying interest rates include the prime rate the banks charge their most trustworthy borrowers and the target rate set by the Federal Reserve Bank. There are many features of bonds other than the principal and interest, such as the issue price, the price you pay to buy bond with its first issued, and the maturity date when the issuer of the bond has to repay you. Bonds may also be callable, redeemable before maturity paid off early. Bonds may also be issued with various covenants or conditions. that the borrower must meet to protect the bondholders, the lenders. For example, the borrower, the bond issuer, may be required to keep a certain level of cash on hand relative to its short-term debts or may not be allowed to issue more debt until this bond is paid off. Next, stocks and stocks markets. Stocks are equity securities or shares of ownership. When you buy a share of stock, you buy a share of the corporations. The size of your share of the corporation is proportional to the size of your stock's holding. Since corporation exists to create profit for the owners, when you buy a share of the corporation, you buy a share of its future profits. You are literally sharing in the fortunes of the company. Next, investment planning. Investment planning is the process of identifying your financial goals and making strategy to achieve them. Investment planning starts with assessing your financial goals and making a list of your goals and ends with investment and regular portfolio monitoring. Next, investment policy statements. Outlines of the investor's goals and constraints are popular with institutional investors such as pension plans, insurance companies, or nonprofit endowments. Institutional investment decisions typically are made by professional managers operating on instructions from a higher authority, usually a board of directors or trustees. Lastly, is the advantages of drawing up an investment policy to use as a planning framework include the following. First is the process of creating the policy requires thinking through your goals and expectations and adjusting those to what is possible. Second, the policy statement gives you an active role in your investment planning, even if the more specific details and implementations are left to professional investment advisor. Third, your policy statement is portable, so even if you change advisors, your plan can go with you. Lastly, is your policy statement is flexible. It can and should be updated at least once a year.
Hello everyone, I am Magda Gabriel F. Avonilio and I am going to discuss to you about commodities and derivatives. Mutual funds, index funds, and exchange-traded funds. Commodities are resources or raw materials including the following: agricultural products, food and fibers such as soybeans, pork bellies, and cotton. Energy resources such as oil, coal, and natural gas. Precious metals such as gold, silver, and copper. Currencies such as the dollar, yen, and euro. Commodity trading was formalized because of the risks inherent in producing commodities, raising and harvesting agricultural products or natural resources, and the resulting volatility of commodity prices. As farming and food production became mechanized and required a larger investment of capital, commodity producers and users wanted a way to reduce volatility by locking in prices over the longer term. And the answer was futures and forward contracts. Futures and forward contracts or forwards are form of derivatives, the term for any financial instrument whose value is derived from the value of another security. For example, suppose it is now July 2010. If you know that you will want to have wheat in May of 2011, you could wait until May 2011 and buy the wheat at the market price, which is known in July 2010. Or you could buy it now, paying today's price and store the wheat until May 2011. Doing so would remove your future price uncertainty, but you would incur the cost of storing the wheat. Alternatively, you could buy a futures contract for May 2011 wheat in July 2010. You would be buying May 2011 wheat at a price that is now known to you, as stated in the future contract, but you will not take delivery of the wheat until May 2011. The value of the futures contract to you is that you are removing the future price uncertainty without incurring any storage costs. In July 2010, the value of a contract to buy May 2011 wheat depends on what the price of wheat actually turns out to be in May 2011. Forward contracts are traded privately as a direct deal made between the seller and the buyer, while future contracts are traded publicly. A mutual fund is an investment portfolio consisting of securities that an individual investor can invest in all at once without having to buy each investment individually. The fund thus allows you to own the performance of many investments while actually buying and paying the transaction cost for buying only one investment. Mutual funds have become popular because they can provide diverse investment with a minimum of transaction costs. In theory, they also provide good returns through the performance of professional portfolio managers. An index fund is a mutual fund designed to mimic the performance of an index, a particular collection of stocks or bonds whose performance is tracked as an indicator of the performance of an entire class or type of security. For example, the Standard & Poor's S&P 500 is an index of the 500 largest publicly traded corporations, and the famous Dow Jones Industrial Average is an index of 30 stocks of major industrial corporations. An index fund is a mutual fund invested in the same securities as the index and so requires minimal management and should have minimal management fees or costs. Mutual fund shares are valued at the close of trading each day, and orders placed the next day are executed at that price until it closes. An exchange-traded fund or ETF, a fund that tracks an index or a commodity or a basket of assets but is traded like stocks on a stock exchange, is a mutual fund that trades like a share of stock in that it is valued continuously throughout the day, and trades are executed at the market price.
Good day everyone, my name is Alea Mendy Cabanas and I am tasked to discuss about defining return objectives and risk. Defining return objectives is the process of quantifying the required annual return necessary to meet your investment goals. If your investment goals are vague, then any positive return will do. Usually, however, you have some specific goals, for example, to finance child's or grandchild's education, to have a certain amount of wealth at retirement, to buy a sailboat on your 50th birthday, and so on. Now, once you have defined goals, you must determine when they will happen and how much they will cost, or how much you will have invested to make your dreams come true. As explained in the Chapter 4, Evaluating Choices, Time, Risk, and Value, the rate of return that your investments must achieve to reach your goal depends on how much you have to invest to start with, how long you have to invest it, and how much you need to fulfill your goals. Basically, return objectives are defined by investors' goals, time horizon, and value of asset base. Now, as we discussed in the Chapter 10, Personal Risk Management Insurance, and Chapter 11, Personal Risk Management, Retirement, and Estate Planning, in investing, there is a direct relationship between risk and return. And risk is costly. Why? Because risk, by its definition, refers to the degree of uncertainty or potential financial loss inherent in an investment decision. So, the nature of this relationship has fascinated and frustrated investors since the origin of capital markets and remains a subject of investigations, exploration, and debate. To invest is to take risk. To invest is to separate yourself from your money through actual distance. You literally give it to someone else or through time. There is always some risk that what you get back is worth less than what you invested, or less than what you might have had if you have done something else with your money. The more risk you are willing to take, the more potential return you can make. But the higher the risk, the more potential losses and opportunity cost you may incur. Now, talking about risk, individuals have different risk tolerances. Your risk tolerance is your ability and willingness to assume risk. Your ability to assume risk is based on your asset base, your time horizon, and your liquidity needs. In other words, your ability to take investment risk is limited by how much you have to invest, how long you have to invest it, and your need for your portfolio to provide cash for use rather than reinvestment in the meantime. Your willingness to take risks is shaped by your personality, your experiences, and your knowledge and education. Attitudes are shaped by life experiences, and attitudes toward risk are no different. In figure 12.7, risk tolerance shows how your level of risk tolerance develops. As what I have mentioned earlier, it is important for us to remember that risk tolerance is defined by the investor's ability and willingness to assume risk. Comfort with risk taking relates to personality, experience, and knowledge. Finally, once you have determined your return objective and risk tolerance, that is what it will take to reach your goals and what you are willing and able to risk to get there, you may have to reconcile the two. You may find that your goals are not realistic unless you are willing to take on more risk. Then, if you are unwilling or unable to take on more risk, you may have to scale down your goals.
Good day, everyone. My name is Jadalci Evergunsado, and my topic is all about defining constraints. Defining constraint in financial planning involves identifying limitations that could hinder your progress towards your goals. Anticipating and including these constraints in your planning can help you to stay on course. Constraint can encompass first we have the liquidity needs. These are the requirements for cash that can slow your investment progress, including ongoing expenses, transaction costs, and the desire to use your portfolio for income or major purchases. Next, we have the time available. The more time you have, the more potential earnings you can accumulate. Your time horizon depends on your age, goals, and specific liquidity needs. Third, we have tax obligations. Taxes reduce the value of your investments, and various taxes such as income, capital gains, property estate, and gift can apply depending on investment type and circumstances. Fourth, legal requirements. Constraint may arise when investments are held within personal trusts or family foundations, as they have legal limitations dictated by their structure. Fifth, unique circumstances. Your individual preferences, beliefs, and values as an investor, such as socially responsible investing, can also be constraints. For instance, some investors prioritize investments in companies with good corporate governance, responsible citizenship, fair trade practices, or environmental stewardship. Some investors avoid financing companies that produce objectionable products or engage in practices with unfavorable political views. This avoidance is often termed divestment, which means removing money from such investment, and this practice is common in grassroots political movements, like students urging their universities to divest from companies associated with non-democratic or oppressive governance. Social responsible investment, on the other hand, refers to making investment choices based on preference regarding desirable or objectionable products or business practices. However, what is considered desirable or objectionable varies among investors, as it depends on their individual's beliefs and values. These beliefs can be unique to each person and may change over time. And once you establish your financial goals, determine your risk tolerance, and acknowledge any constraints, you and your investment advisors can select the best investment. Different advisors may offer various suggestions based on your investment policy statement. The selection process involves considering the historical returns and risk associated with investments, predicting their future performance, and understanding how returns and risks are interconnected. So, recognizing and addressing these constraints is crucial in financial planning to ensure your investment strategy aligns with your goals, timeline, stock situation, and personal values, ultimately helping you achieve long-term financial success.
Measuring return and risk. You may want to choose investments that will combine to achieve the return objectives and level of risk that's right for you. But how do you know what the right combination will be? You can't predict the future, but you can make an educated guess based on an investment's past history. In order to do this, you need to know how to read or use the information available. Perhaps the most critical information to have about an investment is its potential return and susceptibility to types of risk. Returns are always calculated as annual rates of return or the percentage of return created for each unit of original value. So returns are created in two ways. First is the investment creates income or the investment gains or loses value. So calculate the annual rate of return for an investment. You need to know the income created, the gain or the loss in value, and the original value at the beginning of the year. The percentage return can be calculated using this figure calculating percentage return. While information about current and past returns is useful, investment professionals are more concerned with the expected return for the investment. That is, how much it may be expected to earn in the future. So, estimating the expected return is complicated because of many factors. For example, current economic conditions, industry conditions, and market conditions, which may affect that estimate. Returns are the value created by an investment through either income or gains. Returns are also your compensation for investing, for taking on some or all of the risk of the investment, whether it is a corporation, government, parcel of real estate, or work of art. Returns are the benefits from investing, but they must be larger than its costs. There are at least two costs to investing. First, the opportunity cost of giving up cash and giving up all your other uses of that cash until you get it back in the future, and the cost of the risk you take, the risk that you won't get it all back.
Investment strategy. The term investment strategy refers to a set of principles designed to help an individual investor achieve their financial and investment goals. These plan or guides an investor's decisions based on goals, risk tolerance, and future needs for capital. In traditional portfolio theory, there are three levels or steps to diversifying. First, capital allocation. Second, asset allocation. And security selection. Capital allocation is diversifying your capital between risky and riskless investments. A riskless asset is the short term, less than 90 days. US Treasury bill, because it has such a short time to maturity and it won't be much affected by interest rate changes, and it is probably impossible for the US government to become insolvent, go bankrupt, and have to default on its debt within such a short time. The capital allocation decision is the first diversification decision. It determines the portfolio's overall exposure to risk or the proportion of the portfolio that is invested in risky assets. That in turn will determine the portfolio's level of return. The second diversification decision is asset allocation, deciding which asset classes and therefore which risks and which markets to invest in. Asset allocations are specified in terms of the percentage of the portfolio's total value that will be invested in each asset class. To maintain the desired allocation, the percentage are adjusted periodically as asset values change. Security selection is the third step in diversification, choosing individual investments within each asset class. Here is the chance to achieve industry or sector and company diversification. For example, if you decide to include corporate stock in your portfolio, asset allocation, you decide which corporation stock to invest.